Many of the internet names that you cover could well be in the eye of the storm if Europe does increase those digital services taxes that they already hate.
I think that's right, Caroline. I don't have any particular insight into that, but that makes logical sense to me. What I sense is the way these stocks are trading today, the degree of sell-off is kind of determined by retaliatory risk and recession risk. So there are companies that I look at that are just off modestly today because they're perceived to be relatively recessionary resilient. That's names like a Netflix or a Spotify, which are inexpensive consumer subscription businesses. But at the other end are the three mega cap names that I look at: Amazon, Google, and Meta, which are trading off 4 to 9%. Amazon at the top of that list because of pure tariff exposure. There's most of those products that they sell are produced, manufactured, and then exported from Asia. So there's going to be costs that Amazon's going to have to decide whether to eat or pass along to consumers, and therefore depress demand. Meta also has this exposure to Shein, Temu, some of those kind of exporters, retailers that got hit by the removal of the de minimis exemption. So there's a lot of different issues in here, but retaliation and recessionary risks are sort of bifurcating some of the stock movements today.
Had you foreseen this, Mark? Many have been surprised by the aggression shown in the reciprocal tariffs. But do we think this is knee-jerk? Is this in any way a buying opportunity?
Yes, I think it's a buying opportunity. If you tell me that I can buy Meta at less than 20 times earnings and Google at 15 times earnings and Amazon at 23 times earnings, even I understand that there's going to be earnings risk from the imposition of tariffs, from a slowdown in the economy, from a recession. You're talking about mid-single-digit percent, earnings growth. Do you step in and take on a full position today? Absolutely not. But like at these levels, yeah, this is, I hunt for what I call DHQs, dislocated high-quality companies. Look, we had a 2.5-year bull market, uber bull market in tech stocks, particularly in some of these internet stocks that went through the end of last year. Here's your negative catalyst. You now you didn't have any real DHQs at the beginning of the year, but now you do. And so you want to step in on the highest quality names when they're trading at trough multiples. So yeah, I think you want to be picking away at these. I think what you have to also be very cognizant of is this tariff issue is going to play out for a while with retaliations. So you can get all that volatility. Then you've got increasing risk of recession. So you're going to have to be careful about those estimates. And they're going to come down, probably mid-single-digit percent again in a modest recessionary environment. But with these kind of multiples, yeah, you want to start picking away at them.
Could you, in the next earnings season, as soon as that, see a retrenchment in purchasing of IT right now?
Will we see that in the earnings season? I think most of these companies are going to be, and we're just finishing up our previews now, or most of these companies are going to be reporting reasonably solid March quarter results. My guess is that what's going to be consistent across almost all these tech earnings is cautious commentary about end market demand for the June quarter. And therefore, you're going to see cautious guidance that's in line with or below the street for most of these estimates. The only silver lining here is currency, which looked to be a massive headwind for the year. It doesn't look like it's going to be as much of a headwind as thought. So there's a little bit of help there. But at the whole, I think the March quarter results, I think, are going to be fine. I think there's just the guidance is just going to be cautious about the June quarter. So I don't think there's any particular reason for the stocks to trade up on the upcoming prints.
You can totally understand why enterprises would just slow down their commitment to spend on some of your names and some of the technology that they sell. What about the AI trade, though, Mark? It does affect some of your names, like Meta, like Amazon. Does the wind come out of the sails there, too?
I think it has been coming out. I saw that Treasury Secretary's comments about DeepSeek being one of the key factors behind the Mag 7 trade unwind. I think there's some truth to that. Now, I think there's also policy that's just been just as much, probably more of a factor in the market sell-off and in the Mag 7 unwind. The AI trade, I don't think these companies are going to be slowing down their AI capex anytime soon. And I think we're going to see more and more evidence that they're getting a return on that. We're going to get a lot of these good productivity data points. Google is telling you 25% of their code now is being generated by AI, which means that their programmer headcount is probably going to be flat for a couple of years. Amazon telling you that they have 25% lower cost to serve in their most advanced automated distribution centers. That's a massive efficiency gain for a name like Amazon. So I think that's going to come through in terms of margins. The question is what's happening to demand, and is that going to depress the margin expansion we would normally expect from the AI trade? That's the big unknown to me. But I don't think these companies are going to slow down their AI expenses.
Mark, as someone who is every day having to respond to the headlines that we're going to get, many feel that nuance will come. There'll be carve-outs potentially, nearly every analyst anticipating that for Apple, for example. With your names, how are you going to keep abreast of how this changes, how we see other countries respond and try and carve out certain names, or at least, well, try and curry favor with the administration?
Well, I think I'm going to focus. I mean, the sector I look at, the internet sector, has very little direct tariff exposure, except for the retailers like particularly Amazon. It's really kind of the indirect exposure, what impact the tariffs have on consumer confidence and on consumer spend. And so then what you really want to do is look at the stocks that I look at, and I kind of put it together a recessionary spectrum, like who's the most recessionary resistant, who's the most recessionary exposed. And, I think names like Netflix and Spotify are the least recession. They are the most recessionary resistant. That's why they're trading off better today. They'll hold up better. The stocks have year to date. They've actually outperformed the market materially year to date because of this.
But a Shopify, for example, Mark, just to jump in, a Shopify would be on the other end of that.
Yes, it would be. And so would the travel names, too. Your Bookings, your Expedias, your Airbnb, the kind of consumer discretionary spends. Also, advertising names with a lot of exposure to brand advertising. Brand advertising always gets cut before performance marketing. So that's why I particularly find Meta very intriguing here. You brought it down to a very attractive price point. It's the largest performance marketing platform out there that isn't called Google. And I think it actually will hold up fundamentally better than most assets. So that's why I'd be chipping away at the stock here.